So just remind everybody that the meeting is recorded for future use in the council's website or channels. Do we have any apologies?
I do not.
Apologies. Do we have any declaration of interest or transparency statements? No. Item 1 on the agenda is the minutes of the previous meetings. So the meeting of the 22nd of November and the note of the Inquoret meeting, which was the 12th of June. Do we have any questions or comments? Happy to agree the minutes. Okay. Item 2 on the agenda is the Paisley and Renfrew Common Good Fund 6-month report to the 30th of September 24. Who's going to come in and talk on this? Is this Gear we're waiting on, or?
I think David perhaps coming in first.
David's first, yeah.
Thanks, Councillor. So I'll just try and share my screen presentation here. Yep, hopefully you can all see that now. Yeah, morning all. I'll just run through my sort of usual format for my presentation in these meetings, in terms of starting with a bit of market background over the last 6 months to the end of September, which essentially hopefully gives you a high level summary on how major asset classes or markets performed over that period, which should then hopefully be helpful in setting the context for the investment performance of the common good funds, which I'll touch on, and also in your discussions with the investment manager later in the meeting. Please do ask any questions as I go through, or shout if I'm using a bit too much market jargon, which I know is something I can be particularly guilty of. So yeah, starting with a bit of market background over the last 6 months to end of September on slide 2. Yeah, the focus on the discussion will be on what happened to that end of September point, which does feel like a long time ago now. We've had 2 fairly small events since then in the form of the UK budget and, perhaps more notable for global markets, the US presidential election and what the outcome of a Trump presidency may mean for markets. So yeah, I'll try and touch on any changes that we've seen since that end of September period, as it might be more useful just as a result of those events. Anyway, on this slide here we have a few charts. The top one shows the performance of markets over the past 6-month period, past 12 months and a 3-year period on a per annum basis. The one I'll focus on is the columns in the yellow, which essentially shows the performance of those markets over the past 6 months. The first 7 sections or so in that top chart essentially shows the performance of stock markets or equity markets over that period, from global stock markets to the UK stock market to the North American to emerging market stock markets. The next few sort of sections show the performance of bond markets, so both UK government bonds and UK index-linked bonds or inflation-linked bonds, UK corporate bonds and global government bonds. Then finally, the last 2 sort of sections show the performance of property markets over that period and the returns on cash. You can see from those sort of yellow columns, generally it was a positive period for returns on markets, particularly those equity stock markets, Japan being the only sort of negative performance stock market on that chart over the period, with emerging markets in the UK performing particularly well. Bit of a mixed performance on the bonds side, so positive for UK government bonds, UK corporate bonds, but a slight negative for UK inflation-linked and global government bonds. Then also a positive period for property and, well, cash being positive. So I guess question, why was it a positive period? Talk through the sort of inflation growth story that we tend to focus on. I'm sure everyone's sort of aware in terms of, inflation continuing to come down. That sort of has now allowed major central banks to begin cutting interest rates in Q3, which has generally been a positive factor for both equity and bond markets. The falls in inflation that prompted those rate cuts can be seen on the chart on the bottom left here, where we've got, you can see UK and Eurozone consumer price inflation fell below their sort of target rates to 1.7% in September. The US, which is a sort of dotted dark blue or sort of black line there, is a bit higher at 2.4%, but still considerably down on when it was 6 months ago, and yeah, everything down considerably over the past sort of 12, 24 month period. As I've noted in past calls, there is some remaining stickiness in inflation and core consumer price inflation, which, as a reminder, excludes volatile energy and food prices within it. Those are a bit higher, but central banks have got to a level where they're confident that inflation is under control, and that allows them to start beginning to cut interest rates. So we've seen the European Central Bank cut rates twice over that 6 month period. The US Fed cut rates by 0.5%, and the Bank of England cut rates by 0.25% in August to 5%, and actually have since quarter end have cut again by a further 25 basis points at the start of this month to 4.75%. In terms of it, by the end of September, markets were pricing in an additional 0.5% of interest rate cuts from the US Fed over the rest of the year, and I think it's around a further 135 basis points, or 1.35% next year, which would have taken US Fed funds rate down considerably from the sort of current level of around 5% to sort of 3% by the end of next year, implying quite a aggressive pace of interest rate cuts over that period. And that was even prior to, but since quarter end and even prior to the US election outcome being known, markets had sort of pared back in that optimism of rate cuts, just as sort of economic data has been released in the US. Specifically on the US president's election, US yields rose as it became clearer that Trump was headed for victory, albeit, as noted, they'd already risen quite considerably throughout October and on the back of economic data, and partly it feels as the odds of a Trump presidency increased. The market reaction to that outcome seems to be the expectation of stronger near-term growth, given the sort of personal and business tax cuts that are envisioned, and shall we say a sort of lighter touch approach to regulation, which are generally things that are supportive of economic activity and growth. However, on the other side, the sort of expected rise in tariffs, crackdowns on illegal migration, they're expected the things that will ultimately lead to sort of higher good prices and upward pressure on wages in the US, and generally be inflationary pressures in the economy. Turning back to that sort of 6 month period to September on the growth side, those rate cuts that I'd mentioned sort of buoyed hopes of a soft economic landing. So what do I mean by that? I mean, essentially the sort of spike in inflation and interest rates that we've seen over recent years, those factors being absorbed in the economy without leading to severe sort of recessions, and that's been against a backdrop of growth while slowing, but still looking solid globally. In fact, sort of growth in the US and UK economies has been stronger than expected, and sort of global growth forecasts have generally sort of risen throughout the year. Amid this sort of ongoing disinflation and rate cuts, sovereign bond yields generally fell over that 6 month period, though the UK bucked the trend and rose slightly. And sort of post-budget, it seems market expectations again that will be slightly inflationary, and the Bank of England potentially may keep rates higher for longer, so essentially not cut rates as fast as they may have otherwise, absent the sort of 25 basis cut that I mentioned earlier. Moving on to the next slide, which breaks down equity market performance by region and sector in those bottom two charts. The top two charts essentially just show changes in gilt yields and changes in credit spreads, but I won't touch on too much unless there's any questions on those. Emerging markets, as I mentioned earlier, were the best performing region over that period. Seems particularly given sort of stimulus from the Chinese government, which came towards the end of that quarter, which benefited China and broader emerging markets. North American markets again continued to perform strongly, just given the sort of US growth expectations and the high exposure to the tech sector, which continued to be a strong performer. as I noted earlier, Japan is the worst performing region, whilst the UK, the US, and the ECB are on this sort of rate cutting journey. The Bank of Japan is perhaps the outlier in that they raised rates for the first time since 2007 in March and again in June this year. That led to a rise in the Japanese yen and just a sell-off in equity markets in early August. Lastly, I'll touch on the performance of commercial property markets. I think in past calls I've spoken to the property markets have struggled just in terms of through that COVID period and the recovery, but have seen sort of better performance more recently, largely down to the income or essentially the rents that are being received from tenants. But you have seen a sort of small rise in the value of retail and industrial buildings over the past 6 months, albeit office buildings have continued to fall in value. Turning to the next slide on performance. So over that 6 months period to the end of September, and I've got the Paisley Common Good Fund on slide 4, the Renfrew Common Good Fund on slide 5. Essentially, it's a similar picture, some minor differences in numbers, so I'll focus on the Paisley Common Good Fund. That achieved a positive return of 3.7% over the 6-month period, albeit that was behind benchmark performance of 6.1% over that 6 months. That said, over the past year, the fund has returned 18.3%, which is 2.6% ahead of its benchmark. Again, broadly similar story on the Renfrew Common Good Fund, and on a sort of longer term basis, both funds since inception, performance has been around 6.8%, which is slightly ahead of the benchmark. In terms of position of the fund as at end of September, almost 80% is held in equities, which is broadly in line with the benchmark, but there's that continued overweight to overseas equities versus UK equities within that. The portfolio is a slight underweight to bonds, holding around 17.3% versus the benchmark weight of 18%, but balanced against a slight overweight in cash with 3.1% versus 2% in the benchmark. Again, similar story on the Renfrew Common Good Fund with some minor differences in numbers. The last note for me is just around the estimated annual income of both Common Good funds as at the end of September. They continue to remain well above their respective targets, with an estimated income of around 156,000 on the Paisley Common Good Fund versus 125,000 target, and over 595,000 versus on the Renfrew Common Good Fund versus a £475,000 target. Hopefully not a spoiler, but I think there's a proposal later in the meeting just around potentially increasing those targets, given they continue to remain, quite a bit of headroom above their current target, based on current positioning. Happy to take any questions at this point, otherwise I'll pass on to Ger from LGT.
Okay, is anybody, Jacqueline?
I've been reading a lot about Donald Trump and the tariffs, and from what I'm reading, China are saying that they can avoid that or mitigate it somehow. And just in terms of the UK economy, is there anything that we can do to mitigate it if he hammers us with tariffs?
Yeah, I mean feels like it's going to be a very uncertain, sort of volatile picture. I think as well, in terms of the freedom that Trump has got now to implement tariffs, just given the sort of wider election result as well. I think there's always going to be.
So we've had it basically. We've had it.
No. It's one of those sort of, I guess, uncertain things, and obviously, does the policies actually, how do they get implemented in practice, and the sort of extent of them. But it's one to watch out for. But I think from a UK perspective, it's perhaps not as alarming.
Okay, thanks. Alison.
Thanks. Thanks for that presentation, David. It's encouraging to see there's a broadly positive overlook with the funds at the moment. I had a specific question that I was interested in. I was hoping you could explain it a wee bit. On page 34 of our agenda pack, it's under the top 10 holdings and equities section. Both the Renfrew Common Good Fund and the Paisley funds, in both, some of the top 10 holdings as a percentage of the overall holdings are actually in the bottom 10 performers. So, for example, for the Renfrew Common Good Fund, Microsoft is in the top 10 holding. Under the bottom 10 performance, it's quite high up in the bottom performers, if you like. And likewise, there's in Paisley, what was it? Was it Amazon again? Was yeah, sorry, I missed my notes here, but the overall point stands that some of their top 10 holdings, percentage-wise, are actually in the bottom 10 performers. So I was just wondering, do you project that the overall performance of those particular companies that are in the bottom 10 performers, will that smooth out over time to kind of rebalance to justify how much of a holdings we hold in those particular companies, or do you think that over time you'll need to reduce the percentage of the holdings? I was wondering if you could speak a little bit more about that. Thanks.
Yeah, thanks, Councillor Dillon. Ged, is that potentially more one for yourself? Yeah, obviously I've spoken about the tech industry has been a strong performer over sort of recent period, but that doesn't necessarily mean that's every company within it. And yeah, I guess you could probably paint some colour on the sort of longer term performance of those holdings within the fund.
Yeah, thanks. If you don't mind, maybe it makes sense if I share my screen so I can kind of show everyone the slides we're talking about. Here we go, that should be it. Okay. All right, so this is the bit that Alison was just talking about. So we've got on the right-hand side here, top 10 equity holdings by the weighting in the portfolios. We've got Microsoft, it's known as TSMC, Taiwan Semiconductor, Astra. So some of the big companies there, big weightings. But then we go down to the next slide, and this is just over a 3-month period. The weakest ones, you're seeing some of the names as being the main laggards in the portfolio. Really, I mean, so not concerned about that. And actually, I had planned to talk about this anyway, Alison, but thanks for picking it up. Thanks for flagging that. Most of those companies on the right-hand side are actually usually on the left-hand side. And every so often you'll get periods where people take profits, or kind of perhaps the outlook makes people think, well, does the outlook justify the current share price or the valuation? And therefore maybe they'll say, well, actually, let's take a bit of profit from that. So it's kind of a natural occurrence when stocks have performed particularly well. Just, you mentioned Microsoft. I had a very quick look just before I came on, and thankfully David bought me a little bit of time to be able to have a look there. Microsoft for the Paisley and Renfrew Common Good Funds has returned 565%. So the fact that it's down for over a 3-month period doesn't concern me at all. It's been a fantastic performer for portfolios, as most of those companies have been. One of the reasons for that, so they've spent a lot of money on artificial intelligence. It's really expensive. The chips are really expensive. They're investing loads of money. And Microsoft is one example. They came out to say that they were going to charge, and you might have seen on your Microsoft Teams, you've now got Microsoft Teams Copilot, or Office 365 Copilot, excuse me. And so the addition of that, they were going to charge every license holder an extra $30 per month. Now, over the millions and millions of license holders, then that was supposed to bring in about an extra $14 billion of revenue a year. So they came out with these figures of, best case scenario, here's what it could be. The problem is they talk about that, they spend lots of money, we see the capital expenditure going up in these things, and then there's this kind of lag between spending the money and actually finding out how much demand there is for it, and whether or not, artificial intelligence really is going to be what we all want to be using on a daily basis. So yeah, so there's been a bit of a lag, and so some of the companies are kind of saying, well, you have spent a lot of money. We're not entirely sure the uptake is going to be as significant as you first said. In which case, we're just reviewing what we think the fair price is for the share. The market only works if you think that Microsoft's going to keep going down and I think it's going to go up. That's great, because you might be looking to sell it and I want to buy it. I can only buy it if somebody else wants to sell it. And so for a market to be working properly, you need to have these different views about companies and assets and everything else. And so actually, it kind of just shows me that some people think it's topped out at a price for the time being until we get some more information, and they've just taken some profit because it has done so well over so many months and years. The other thing really then is if we look at the left-hand side of that, and forgive me, I'll try and zoom in a bit more, it's probably quite small on your screens. Oops, it's a bit more I meant to zoom in. There we go, hope that works. So these companies on the left-hand side, the ones that have done particularly well, again, over just that 3-month period for Q3 of this year. There's a theme, national grid, so power infrastructure, next year energy, a US, biggest utilities company in North America, Enel, utility company, Ørsted, biggest owner and operator of wind farms. Many of these have had a tough time, especially Ørsted in particular. I've talked about it before because when they're putting in infrastructure, putting in renewables, we've had the cost of capital going up because interest rates have gone up. So when they're borrowing money to fund the construction, the cost to do that has gone up, wages have gone up, and materials have gone up in price as well. So lots of inflation and interest rates. And so that's really hammered many of these companies where you're kind of looking at, well, how much are you going to be paying? They're in a very regulated sector, the utility sector. How much can you be paying out to shareholders? Actually, if you can be paying out 5% per annum and suddenly you can get 5% just in cash in the bank, makes them less attractive. As interest rates look like they're going to keep coming back down, maybe not as fast as we first thought, but keep coming back down over the next couple of years, then that makes them a bit more attractive and they've come back into favour again. Also, more infrastructure spend in the UK as well, expecting more infrastructure spend. There's a big problem just now that we've got all these renewables, but we can't get the electricity from the site to the to the grid, and so companies like National Grid stand to benefit from that, as there's a greater emphasis on boosting that infrastructure. So there's all these sorts of things. So it's a very short time period. My colleague actually did update or looked at this slide, if he did it not over 3 months, but over 12 months. And the laggards are on the left-hand side again. So not something I'm concerned about, but thanks for your question. Chair, should I just go into my bit that I was going to talk about, or do you want to invite any other questions first?
No, unless Alison's got further questions on that, I'm happy for you just to carry on, Gair.
Great, thank you. On the Trump tariffs question as well that Jacqueline asked, I might try and come back to that. I was glad I went to David because who knows really. But actually what I might show you, I won't go through my macro slides because David's done such a great job, and actually I noticed that at least one of the charts was exactly the same. However, this I think just is quite interesting because it shows on the left-hand side how the markets have performed in the US, and then on the right-hand side in the UK, depending which party was in power, whether it was Republicans or Democrats in the US or Conservatives or Labour in the UK. And actually doesn't really seem to matter that much. Now, as obviously working in finance, I'm very familiar with saying the whole thing about past performance is no indicator of future performance. And I think especially when it's Trump that's going into power again, then that's perhaps even more so the case. Tariffs. What will that mean? Well, could well be inflationary in the US at the same time as they're talking about throwing out all the undocumented, the 15 million undocumented illegal immigrants and workers. But that would probably then push up prices as well, because companies to try and find workers, sort of meat processing, lots of warehouse jobs, and the restaurants and service sector, it's expected that I think it was 56% of employees are believed to be undocumented immigrants. So the implications of trying to get other people to do those jobs would likely mean that they'd have to pay higher wages to attract them into that sector, and that would then have to get pushed through to prices as well. So that'd be inflationary too. So what does it mean? Trump obviously doesn't want to see inflation going back up or staying stubbornly high because he has shot Joe Biden down for that during the campaigning. So I think that what they'll probably do with these tariffs is try and utilize them as bargaining chips to find ways of getting stuff into America cheaper, or especially getting people to manufacture more things in North America, which is what he tried to do in his first term. If you've read any of the stuff about who he's appointing to his equivalent of the cabinet, it's quite scary. And even just listening to an investment call this morning, and they're talking about how they're apparently the Trump and his cohort are talking about suspending the Senate, basically putting them into recess because they can be kind of that sounding board. They can do the sense check to make sure that the right sort of people are appointed to the right sort of jobs. They're talking about putting the Senate into recess so then you can basically just do it without that sense check. So quite a concern, never mind looking to replace a lot of the military senior commanders with people who are more willing to do what he says, because there's that frustration during the Black Lives Matter campaign protests that the army said, no, it's against the Constitution for us to go out onto the streets. And he'd asked the army to go out onto the streets during that time. So I think it'll be, unfortunately, a fascinating spectator sport, even if for all the wrong reasons. Anyway, back to the portfolio, which is obviously what we're here to talk about this morning. If we look at the portfolio and how it has performed, so top left-hand side here, how the Renfrew portfolio, how it's sitting at 11th of November. I updated that again. Bear with me, look at my notes. Oops, there goes my phone. Updated that overnight, looking at last night's close, and it was sitting at 19.3. So it's come back a little bit, but markets have been a little bit weaker with all the sort of uncertainty that is going on, and especially with the expansion of hostilities in Ukraine, firing of missiles into Russia using Western munitions and onto Russian territory. And in addition, this morning is saying about being able to utilize anti-personnel landmines as well, which is an unfortunate development. But the portfolio has generally been doing pretty well, up year to date. So this is at the close of play last night. The portfolio is up 8.7% for the Paisley and Renfrew Common Good funds, and over the last 12 months, about 13.6%. So good performance. If you look on the right-hand side on this blue bit here, then you'll see that actually fixed interest for a long time. I was saying about, well, do we need to have that minimum of 15%? And then probably about a year and a bit after being able to have that relaxation, I've now got it over 18% because it actually become much more attractive. David showed in his charts about how the 3-year performance of bonds has been really weak, but they started to move into positive territory. And so could see that there's a really attractive point that's adding more bonds, and I chose to do so. And that helped increase the portfolio performance, and will continue to do so for quite a few years ahead. I managed to buy them at a discount to face value, which is exactly what I'd like to do. When we look at the equity component, it's sitting just a smidge over 80%, but you'll see that the UK, we've got a preference for overseas companies versus the UK. The UK has got some of the renewable sector, it's got some of the insurance companies and pharmaceuticals, and even things like oil and gas companies and miners, albeit most of those being disinvested from your portfolio. The overseas equities we like, again, David's chart was showing about the performance of emerging markets. If we can get exposure to emerging markets, but from companies domiciled in Europe, US, and UK, then that's our preference. And I've talked about an example before, ASML, which is based in the Netherlands, but most of its revenue comes from South Korea, Taiwan, and Hong Kong. So for us, that just is a more prudent way to try and get access to the revenue from those regions without owning companies domiciled there. But as a result, we've got a reasonable allocation to overseas companies. Cash pretty low. It's actually been sitting mostly probably around about the 2% mark, just because I've been doing a bit more trading. I added a couple of new companies. Owens Corning might not be familiar. It's a company that's a leading manufacturer of building supplies, based in the US, and they have both the residential and commercial side of things. But they got good distribution network through Home Depot and the big sort of retailers like that. But they manufacture a mixture of simple things: doors, composites, roofing, and asphalt. And so they've got a good market share for that and performed well. And then the other one I added in was Constellation Software. They buy up and manage companies that provide software which is very specific to a sector. So it's not like a software that might be used, like Sage accounting software, not like that. It can be used across a lot of sectors. This is specific software used for specific purposes, and they buy up and manage those across the US and the rest of the world, based in Canada. So that's a couple of names I've added in on top of the increase in bonds. We move down a little bit more, so you see the portfolio performance there is talking about, so about 5.2, about 19.8, 19.9 million pounds at the end of the quarter. Performance over the year, let's say about 18%, really strong performance. Delighted with that. Everything's kind of softened off a little bit in the last couple of months. Against the benchmark, it's performed well too. I know against ARC, Charities Steady Growth. So that is the average of our peer group for about 35 of our contemporary companies, our peer group in the investment sector. And that's for charity specific performance. As a reminder, the performance here is net of all fees. Now, when we look further back, I'm challenging some of these. I think some of the benchmark performance, I challenged for another client, and they realized they'd made a bit of a mistake in those. So I wouldn't add too much into that. We're normally against the benchmark across most time periods. One thing which might have skewed this is your heavier weighting towards UK. And some of those UK companies, the oil companies in particular, did quite well through some of these time periods. So that might be why that looks higher. But I'm just asking a few questions because I don't think the benchmark performance is entirely accurate for that period. So my apologies for that. The asset allocation, I don't tend to go through. It's more just to show you that we've got diversification. Your assets are across many different baskets, eggs in different baskets. We've got asset classes, so equities, so company shares, bonds. This is when you're lending money to both companies or to the government, and they essentially pay you a level of interest and then pay you back the original amount at the end of the term. And then alternatives, which we look at renewable energy, social infrastructure, so the companies that build the bridges, the ports, the schools, private equity, so this is companies that are buying up unlisted companies, still quite big companies, but unlisted, and then a bit of cash as well. And then you see the distribution across the different industrial sectors too. So eggs spread across many different baskets to try and mitigate the potential risk. And the last one from me before I hand back to the chair is really just to give you an idea of some of the other stuff that we're doing. And I'd like to try and get access to this in the charity portfolios that I manage. Enel is a utility company based in Italy. They generate most of their electricity from gas, especially after the Russian invasion of Ukraine and the loss of their, or the sale of their gas and LPG production in parts of Siberia. There's a thing about if you buy a company shares, if you buy a company in, let's say BP, then yes, you can attend shareholder meetings and vote, so you can try to influence things, but the company can, to a large degree, kind of say, okay, we hear what you're saying. If you've got enough shares, if you've got a significant enough ownership, we might listen to you, and okay, we might make incremental changes. But it can be more difficult sometimes. And so I'm hoping to write a paper on this over the next 12 months, which would actually look at bonds versus equity. So equity is those company shares where you actually buy a share in the company and you can vote on it. But it doesn't really change how the company finds the money to keep operating. Bonds, fixed interest, they do, because that's where the company actually goes out to the market and says, lend us £1,000, we'll pay this much interest, and then we'll pay £1,000 back in 5, 10, 30 years, whatever it is. I just think that actually being much more specific and mindful about where and what companies we lend money to and how we do that will probably have a far faster positive change. Because if we say to a company, we'll lend you money, but it's not going to be a traditional bond, it's going to be a green bond, which means that you can only utilize it for certain defined and audited purposes. And I think that will probably could bring about change far faster than just voting at company share meetings. I think about, and I bore my friends with this and family with this all the time, but if we think about our personal lives, essentially every pound we spend is a vote for something and or against something else. And if we all kind of think about, well, I'm going to buy this product because actually it's manufactured in a better way, and it's got, they treat their workforce more fairly and all the rest of it, and I'm not going to buy that other product. If we all kind of thought like that, then actually I think we'd probably see a lot more positive change coming about. So I want to write something up, and what I'd like to try and do is get access to these green bonds so that we could go to companies like Enel and say, we like what you do, we like the direction of travel, but to really try and make it clear what we like about what you're doing, we'd like to invest in your green bonds rather than the other bonds, so that forces them to invest more in that side of things. Chair, there's a bit of a deviation from the norm at the end there, but I hope that was of some use or interest. And hand back to you.
Thanks, Gareth. No, that was really interesting. I'm not sure I'll be accepting your offer for come along to your dinner party, though. If these are the lectures we're getting, I'm not going to eat my chocolate anymore. No, that was great. Thank you. Do we have any questions, comments? Jacqueline.
No questions. Just I really enjoyed that presentation and this particular case study as well, and would be fully behind that. So, and I'll think about how I spend my pound as well. So, yeah, I'll think about that going forward.
Okay, thanks for that. Next item on the agenda is the review of the investment policy statement. Christine, are you going to talk about this?
Thanks, Chair. Jeff pulled this together, so I'll pass over to him to speak to the changes. Thank you.
Thanks, Christine. Yes, this is just the annual review of the investment policy statements for both funds. What the benchmark should be, income target, any restrictions on the investment fund manager and the like. So the policy statements for both funds are effectively the same, except for the income targets, which are in line with the actual size of the fund. And the changes that we are recommending to make are the first one's paragraph 8 of both statements, which is the income target itself. For these, we're just recommending we change them in line with the change in value of both funds, so that the percentage target yield remains constant. So for the Paisley Common Good, this would be an increase of from 125k to 129k, and for the Renfrew Common Good, that would be 475k to 492k. So we just think this is an acceptable target for GEAR, still challenging, which would be in line with previous targets, and still achievable without having to take higher risks than we would be comfortable with, or sell any capital to achieve that. The other change that we have recommended is to the benchmark itself, which is the table that's in paragraph 16 of both policy statements. So GEAR was touching on that there, that our current benchmark is of 60% in UK equities and 20% global. But GEAR was talking there that it's actually almost the other way around, that both funds are close to 30% global. 30% UK and 50% global, as that's achieving the sort of optimal return at the moment. So we're really just recommending to change the table to a 40-40 split, so that the benchmark will more accurately reflect how the fund currently is and give a better indicator of the performance of the fund. The only other change is to paragraph 18, and that just is reflecting the new contract terms that have been agreed with LGT, and that was completed at the start of October. So we're just recommending the board approve those changes, and something else that might be worth considering is the investment restrictions, particularly around paragraph 13, that have the ethical restrictions around tobacco, gambling, fossil fuels, arm trade. So if there's any discussion or conversations, this is probably a good time to have that about them.
Okay, thanks, Jeff. Any questions or comments? Are we happy to accept the recommendations? Not seen any hands. Okay, good stuff. Thanks, folks. Date of next meeting is the 11th of June, months away.
Sorry, Chair.
Yep.
I think the plan was to have a little bit of a development session at the end of this meeting,
right.
which I think Gair has prepared some training.
Apologies. I forgot about that.
Is that all right?
Yeah, so Christine, shall I go through kind of what we talked about previously about just talking through the pack and talking through kind of trying to sort of look at things from a sort of trustee's perspective?
Absolutely. I think some of it, you do quite a good job of busting the jargon, I think, as you go through, but it's really for the members to bring that to life a wee bit in terms of the decision making that they have to consider. So yeah, I think that what we had talked about would be ideal. Thank you.
Yeah, okay. Now let me just try and bring this back up again. Here we go. So yeah, we chatted, Christine, Jeff and myself chatted about, trying to make sure that everyone, we've got a real thing about trying to make sure that people on boards feel they've got a sufficient level of understanding to be able to challenge, to hold me to account and make sure you feel you're getting the best service. And also that's, if something doesn't sound right, they can just go, wait a minute, tell us a bit more about that. Or even just thinking about what to focus on. Because I know that board packs seem to go longer and longer and longer. Many of my clients are saying that their board meeting papers have got so long in recent years, so recent months and years, and can be quite challenging. So I've spent 10 years on charity boards. I was an executive director of a Scottish charity before I moved into the world of investments. And obviously I do this as a day job. I work only with charities and organisations such as Renfrew. I realise you're not a charity anymore, but thinking of the same sort of structure. And so when we talked about things, saying, well, perhaps even just mentioning what would I be looking at? If somebody presented this pack to me and I was on your side of the table, what would I be focusing on? Now, okay, front page, yeah, my biography, skip that. Even the market stuff, okay, it's maybe of some interest. Would I be focusing too much on that? Perhaps not. I might have some interest in what's going on in the markets, especially with inflation and interest rates. But if I'm totally honest, the part I would probably jump to first of all would be this page and the next page. Here we've got, okay, now of course with the approval of the new income targets are perhaps a little bit out of date, but here we've got, if you can see my little cursor, income target £475,000 for Renfrew and £125,000 for Paisley. Where are we? I'll be looking up here then. What's expected to be produced this year? Okay, there's a reasonable margin over 475 and there's a reasonable margin over 125. Great. That's probably the first place I'd jump to when I opened the pack. I'd then also be looking at, and forgive me, I will jump around a little bit, but for the right reasons, I believe. I'd then be looking here and be starting on the right-hand side and thinking from 31st December and getting progressively closer to today's date, how has the portfolio been performing and how has the income been performing? And if there's any significant dips, I'd probably be saying, actually, I want to ask Gair about that. So 18.5, 90.5, 90.8. Okay, so that all looks kind of good. Income progressing up. Okay, dip back about £6,000. Is there a reason for that? Yes, there is. We sold Mercedes. Mercedes paid about 10% dividends which if you think about bank interest, it's like getting 10% in a bank account kind of thing. So they paid income of 10%, sold it just because actually a significant slowdown in luxury goods, luxury cars, and Chinese alternatives coming into the market, and just felt that we'd done quite well for Mercedes, but actually it was probably time to move out of that. So I sold Mercedes, and that's why it dipped. But if I was on your side of the desk, I might be saying, well, Gary, can you just tell us a bit about why the portfolio income dipped? Do you think something's changing? Is income going to come under more pressure? So that's probably one of the first questions that will be popping into my mind. Looking at this, okay, what else are we looking at? Are any of these totally out of kilter? Okay, 18% against what you've said, 18% for me to kind of use for managing a portfolio for the longer term. The fact that this is, say, 27% against yours of 60, 54 with rounding against 20. Can you tell me a bit more about why that is, why these seem to be the wrong way around versus these? And that's when I was trying to explain about the companies we like, companies that got exposure to revenues, but are not domiciled in some of those areas, and also liking technology, liking pharmaceuticals, liking certain companies who tend to be based outside of the UK. So that's probably the other thing. So anything which stands out as being a bit peculiar versus this benchmark, which is what you have stated that I should be referencing when I'm managing the portfolio, albeit I'm not bound by it. So that's the first 2 or 3 bits, and these are just where I'd go straight to as soon as I opened the pack and looked at that. I'd then probably be looking at this, the performance. Okay, now the composite benchmark, you are going to be changing that, so I probably wouldn't worry too much about that. But the ARC, because this is the independent organisation that collates the performance of our portfolios for charities, plus also those of 35 of our peer group. How have we performed, the ones in bold? How has the investment manager performed versus the peer group? Okay, so generally they're above, a bit below there. What was the rationale for that over that 3-year period? Why was it below the peer group over that 3-year period? Actually, it was because we don't really like banks. I find that banks are so complicated these days that it's hard to actually know what you really own, and as a result, tend not to own them. Now, that's generally been a good call, or at least it hasn't really worked for us or against us over most time periods. But as interest rates have spiked over the last 24, 36 months, then if you think about being a bank, when interest rates were 0.5, you could issue a loan with maybe 1% on top of that. So 1.5%, maybe they're issuing a loan for. That's what they're charging you in interest, because interest rates were 0.5. When interest rates go up to 5%, as they were, 5.25 even, you can probably charge 1.5% on top of that. It doesn't seem like such a big jump up because interest rates are already 5%. And so it means that it's called the net interest rate margin, or NIM. It means that banks can make more money when interest rates are higher. So we've talked about it frequently, we've considered it frequently, but we still feel that when we're buying companies, we're looking for quality. I just feel that they do not pass our quality metric because they're just too opaque, and we just feel we wouldn't know what we're taking on board by buying them. But yeah, we did underperform because of that when interest rates spiked up, and it looked like they're going to stay higher for longer, as they did. So that's the other thing. Have we underperformed the ARC index over any time periods? And I'm probably saying, can you tell me more about that? The other one, and forgive me, I did talk a bit about this, equities, just company shares, known as company shares because you're actually buying a share of the company. You're buying into the ownership of the company. You get access to vote, and you can try to submit resolutions and things like that to try and drive for more positive change. But it can be quite challenging, especially if the big companies like BP, Shell, multinational companies, and trying to bring about change with them can be quite challenging. To reflect that, within LGT, what was our national head of sustainability, who sort of coordinated all the engagement and engaged the companies to try and drive forward and lead to that positive change. Siobhan, so she's actually been promoted to a global role, so that when she approaches these companies, she doesn't represent the £30 billion of assets we manage in the UK. She represents the £300 billion of assets we manage on a global basis and can put more weight behind that punch, if you like. So we've got these equities, these company shares, and a variety of different sectors. One of the reasons for holding company shares and why that makes up the largest part is that if you think about companies that manufacture goods or sell services, you roughly expect that for many of them, if there's inflation, that their prices might be going up something in line with inflation or thereabouts. And so if you want to try and protect the portfolio against the impact of inflation eroding its value, then owning company shares is one way to try and do that, while generating income as well. Because if you think about it, if you had inflation has been so high over the last few years, if you just had £1 million under your mattress 3 years ago, and then you brought it out now, but inflation's been running very high over that time period, what you could buy with that £1 million now would be far less than what you could have bought with it 3 years ago. And that's why for organisations such as the Common Good Funds and for charities who might have multi-generational time periods, then ensuring that inflation doesn't erode the value of those savings is really important. Bonds, as I mentioned, is essentially an IOU. You're lending money to companies or governments, and they'll give you that amount back and pay you an annual level of interest on top of that. Government bonds are perceived to be the lowest level risk that you can invest in. So I have increased that in the portfolio because they become really quite attractive, or had done. So getting about 4.5% interest return on those, while not really taking on board any more risk. The alternatives, and forgive me, I may have mentioned this before, but the renewables and infrastructure in particular have had a difficult time. I said material price increase, bank rates increasing, wages increasing, all squeeze their profit margins because the price they generate for the unit of electricity or whatever is fixed. Or if they built a school and then leasing it back to the government, those payments are fixed and their costs were increasing in the background. So it has made it a bit more challenging for them. But still, a good place, a good rationale to have them in the portfolio. So thinking again, what would I be focusing on? I'd be wanting to understand any significant changes in the portfolio. I'd probably be asking, as Alison did, about the any companies that had performed poorly, what the rationale is for those, whether or not we've sold any of those. If any are doing particularly well, I mean, these sorts of figures, double-digit figures, are nice. They're good. It wouldn't make me think anything untoward, positively or negatively. But that's just kind of nice to see strong returns. That happens because of they're reporting better earnings. If any of the holdings in the portfolio are getting really quite high, now this is actually a fund, so it's actually got exposure to about 500 bonds inside that. So again, I wouldn't be too concerned, but I might ask. If I didn't know that, I'd probably ask about that. That is quite a high exposure within the portfolio to one thing. And then the other thing I might look at are just the ethical screens. Do they still represent what we think they should be? And we do an annual review of these. Does this still look to be representative of how the organisation feels about these sectors? Christine, I feel like I'm missing something that we talked about last time, but I can't think what it is. Is there anything you can think of that I forgot to cover?
No, I think that last point you made there was where I thought the focus might be in terms of discussion about what people might want to think about, but in terms of the ESG indicators. But no, I think generally that's covered what I was expecting. I guess back to the chair. Is there anything that you would like to know that may have been missed?
No, I think that was really helpful. Alison was coming in with a question here.
Thanks. It was more a comment, just to reiterate what you were saying there, John. I found that really helpful as well. It's helped to consolidate some questions that I had in my mind when I've given the papers an overview. but not quite having the vocabulary to put it into words to ask a defined question at times. So I found that very, very helpful. And if there's any further suggestions through the chair of extra development sessions like that, I would welcome that. Thanks.
If I may just nip in there, Chair, just to let people know, and actually I should send this across. Actually, Josh, you're on the call. Perhaps you could send this across to Jeff afterwards. We've set up a charity resource hub. So we've got some stuff on there. We're adding to it as quickly as we can get the things recorded. And they're going to be the sort of bite-sized 2-minute long videos on what is a company share, what is asset allocation, and just picking off key topics, not just on investments, but also on governance, and just trying to make it no longer than 2 minutes to make it, easy to understand, plain language. And so that's something we've got on there, as well as some key documents which might be of use. So that could be quite helpful.
Yeah, that'd be good. I think this. I mean, obviously, I've chaired this board for 7.5 years, so I kind of a lot of the stuff that you're talking about there, which we should be questioning. That I've understood as we go through, every 6 months why we're doing this, and why this is happening. The weighting in terms of international and UK. I understand all that, but I think possibly. I think myself and Councillor Nicholson are the only 2 members from 7.5 years ago who are still on this board. I think this is possibly something that should be. I don't think it was picked up at the start of a council period. So after an election, something like this, some sort of in-depth training should take place to allow people to be a bit more informed as to what they're actually seeing in front of them and what they should be asking about. I think that's something that should certainly be set up as we do this every 5 years. This is the big in-depth one. There may be some sort of pack for new members that are coming and going. But I think it was very helpful, and it wasn't complicated. It's not. There wasn't. You're talking there, Gear, as you always do. And I wasn't thinking, what's he talking about? It's all fairly simple when you think about it. And as councillors who are used to looking over, lots of papers with lots of figures and stuff like that, we are all probably used to this sort of thing, but just not in this context. So I think possibly, some sort of training package for the start of a period, and something that somebody could pick up would be very helpful moving forward.
Delighted to support.
Christine?
Thank you. I was just also going to say I'll take a note of that for adding to members' development for the new cycle of members coming in. So I'll speak to Mark about that.
Still years away, Christine. So
yes,
don't forget because I will. So I think that's us this time. So unless anybody's got any other questions or comments, we'll call it into the meeting. The date of next meeting is the 11th of June, and we'll see you then. Thanks, folks.
Thanks, John.
Thanks,
Thanks, everyone.
Thanks, David.